Hey everybody, it's time for another round of managerial accounting. Now, at this point in the game, you should have a pretty good understanding of what direct material, what direct labor, and what factory overhead is. Our goal today is to take that knowledge, that good stuff that you've gained already in the chapter, and now we're going to apply it to an actual accounting system. And we're going to talk about the job order cost accounting system. That's going to be our goal for today, is to take our understanding of product cost and see how it is applied to an actual accounting system. I'm excited. I always like to apply what we know and what we've learned, so we'll get right to it. Last time we talked about Nike and the product cost of what it took to create a pair of shoes, and we said we had to have direct material, we had to have direct labor, we had to have factory overhead. We broke all that down for you in our video before. And as you can see right there, we know now that direct material cost plus direct labor, let me get my pen here, it's all over the place. Our direct material plus direct labor plus factory overhead is equal to our total product cost. So as I said, today's video, how do those product costs flow through our accounting system? And our example we're going to use today is called a job order costing system. A cost accounting system is just simply an accounting system set up to measure, record, and report the product cost. So in a job order costing system, we're tracking product cost by a job. And we're making groups of products, and every group we make is going to be a job. So if we think of Nike again, maybe an example of a job would be job 3201, 250 pairs of black Air Max 90 size 11. Okay, so that would be an example of a job, and we're going to track all the cost of that job separately from every other job we have. Okay, so every job is kind of its own little thing as far as product cost go. And if you want to think of a different environment for Levi's, maybe a job might be 50 pairs of 501 stonewashed jeans. And maybe for Apple, a job might be 1,000 iPhone 9s or whatever. So the idea is every kind of group of products that we're making and manufacturing is going to be a job. And again, we can apply it to a service firm as well. For a CPA doing taxes, every individual tax return is a job. It can be something like that. A construction firm, every house they build is a separate job. So again, we're looking at building things, making things, providing services by job here. We're going to track the flow of cost all the way through the job. So if we're talking about a manufacturer, we're talking about Nike, the flow of manufacturing cost begins when they buy raw material. And raw material is an inventory account. Obviously, inventory means it would be on the balance sheet, raw material inventory. Anyhow, we can have direct material, we can have indirect material, but we begin our process, regardless of what we're making, with material. Then that material gets put into production. And it becomes work in process inventory. Work in process is a job that we've started. We've started making the product, but we haven't finished it yet. It's just like it says, it's in process. And again, as an inventory account, it's on the balance sheet too. When we get done with the product, we've finished it, it's completed, it's packed, it's ready to go, it becomes finished goods inventory. Again, inventory is on the balance sheet. We've finished it, but we haven't sold it. So the flow of materials goes from raw into work in process into finished goods. These are all inventory accounts. In our financial accounting, you only thought of one inventory account. But in reality, if you're a manufacturer, you could have three. The raw material you use to make the product that hasn't been put into production, work in process, stuff that started, not done yet, and then finished goods inventory. That's what we traditionally think of when we think of inventory, right? So Finished goods inventory, it's sitting there in the warehouse or on the shelf waiting to be sold. Once it gets sold, it goes from the balance sheet on inventory to cost of goods sold, right? You all remember cost of goods sold, income statement account. So that's kind of the flow. When it's inventory, it's on the balance sheet. When it sells, it goes to the income statement, cost of goods sold. That's the flow. And as you might imagine, we have either paperwork or electronic means to kind of help us track that flow. So when we look at materials, we kind of have two documents, or maybe these are digital items, but we have receiving reports for when we get the material and check it into our accounting system. And then we have materials requisition. A materials requisition is basically someone in the factory or on the line saying, hey, I need materials to get the production process started. And they get those materials out of raw material and they start them into production. So you can see here we have a couple of examples of these documents. We've got a materials ledger. In this case, they're keeping track of wood that would go into a guitar. So they have the name of the material, maple wood. They have the amount received, and tie into your receiving report right there. And then they have the amount issued into production. So there's the requisitions where we're saying we need the material for a job. And then down here, we have the actual job cost sheet. Again, we're keeping track of our cost by job. And you can see we have job 71, we have job 72. Materials have gone into both of those jobs. $2,000 for job 71, $11,000 for job 72. So we keep track of the material as it goes into our cost accounting system as we begin production. Direct labor, that second component of our product cost, usually that comes from some kind of time ticket. We punch in, we punch out, we log as an employee on the line what jobs we're working on. And you can see examples of time tickets here. For job 71, here's the employee, here's the work they did, and there's the times and the cost on the labor. That $60 of labor gets added to job 71. I should say $60 times the hours worked. Job 72, same idea. Hours worked, and the cost of that labor going to job 72. Direct material, direct labor. Direct labor is going to be reported on some kind of time card or time ticket. And again, it could be a paper document, it could be on a computer, either way. As I mentioned in our other video, direct material, direct labor, man, that's the easy part. It gets traced directly to the product. It's easy to see. It's easy to figure out what's going into it because it's directly related to the product. The hard part, OH. I'm not talking OHIO. I'm talking overhead. Figuring up the overhead. That's the hard part. So when we talk about tracking the cost of factory overhead, some different items are indirect material, that materials requisition that we saw a minute ago. That'd be our document for that. Our materials rec. Indirect labor. We have our time ticket. Help us keep track of that indirect labor as well. But what about stuff like factory utilities? We get our water bill, the electric bill. Literally, that information is going to have to come from those bills. When we get those bills, we'll put it into overhead. And then factory depreciation usually comes from the accounting department, telling us how much we are depreciating on our factory machinery. But all those costs are indirectly related to the jobs. As such, they have to be allocated to the jobs in some way, shape, or form. And that's where the tricky part comes in. The whole idea of allocating those overhead costs. If we don't allocate that overhead to our products, we're leaving off a lot of money on our product cost, which means we may not charge enough for the product to cover our cost. We definitely don't want that scenario to happen. So we allocate that factory overhead according to a common measure that's going to be related to every job we do. That common measure is referred to as an activity base or an activity driver. What's driving overhead? Kind of the idea here. So in a shoe factory, like at Nike, maybe our overhead item is supervisor salary on that factory production line. The driver for that, or the activity base, might be the number of direct labor hours. That's what's driving that overhead cost right there. Okay? The more labor hours we have, the more wages and people that are working, the more supervision they might need. More people, more supervision. If we're talking about an overhead item of factory utilities, maybe a good driver for that might be the number of machine hours. The number of machine hours, electricity, would determine factory utilities. It would be the driver for factory utilities. And so what we try to do when we allocate all these overhead items is we try to find a common measure to allocate them on. Okay? And so I've got these dollar amounts here of overhead. I'm going to try to allocate them to the product based on a driver of maybe labor hours, based on a driver of maybe machine hours, whatever the case might be. So what we do is we allocate factory overhead using what we call a predetermined factory overhead rate. Predetermined is a really big, long word. I'm not a big fan of that word. I'll give you an easy word here. I like easy words. I like estimated. Instead of predetermined, I estimated factory overhead rate. Okay? And the way we come up with that is we take the estimated total factory overhead cost and we divide it by that estimated driver, or that estimated activity base. So you see why I like the word estimated there? Because the formula, literally the calculation, is based on estimates. So why not just call it estimated factory overhead rate instead of coming up with some predetermined word? Let's give an example, make it a little concrete here. Calculating that estimated or predetermined overhead rate at Nike. We're going to assume Nike estimates total factory overhead cost of $50,000 for the year. Their activity base is going to be direct labor hours, of which they had 10,000. So to come up with that predetermined factory overhead rate, we divide the total estimated overhead cost by the total estimated activity base. $50,000 of overhead. We're going to spread it out over 10,000 direct labor hours. And they're going to get $5 an hour. So my predetermined factory overhead rate is going to be $5 for every direct labor hour that's being worked. So, okay, big deal. What do we do now? Well, once we have that rate, that estimated factory overhead rate, we can apply it and apply overhead to our jobs. So we had job 71, we had job 72. Job 71 had 350 hours of direct labor. Job 72 had 500 hours of direct labor. So literally, we just take both, multiply them by 5, and that's how we're going to apply overhead to those jobs. Those jobs have to have overhead put to them in order to cost them out correctly. If we leave off that overhead, man, look, we're leaving off $2,000, more than $2,000 on job 72, nearly $2,000 on job 71. We would run a risk of pricing those jobs too low if we didn't allocate or put some estimated overhead to them. Okay? So to put all that together, you can see we got applying factory overhead to jobs right here. We got our time tickets, and then using those to calculate our factory overhead. So now job 71, it has direct material, it has direct labor, and it has factory overhead put to it. So our total job cost for job 71 is $10,250. We would want to make sure we didn't sell that job for less than $10,250 because that's what we have in it. We want to sell that job for $12,000, $14,000, $15,000, whatever. Job 72, direct material from the materials requisition, direct labor from the time ticket, factory overhead based on direct labor hours, and we got a job cost of $21,000. So again, your job cost for every job is going to be the sum of the job's direct material, direct labor, and factory overhead. The factory overhead is allocated. We're estimating and putting some overhead to that job in real time. So, put it all together. One more graphic to show you here. Goodness gracious, look at that. What in the world? We got T accounts going on. We got everything else. All this is showing you the flow of cost all the way through the accounting system. Now we're doing managerial accounting. I'm not going to beat you over the head with journal entries and make you journalize all this stuff. We'll save that for the accounting majors. But if we look, we got the materials T account right here. This is the raw material. As an inventory account, it's going to go up on the debit side and down on the credit side. So you can see it's going down, meaning these materials are being put into production, either indirectly into overhead or directly into work in process, which is also an inventory account. So it means it would go up on the debit and down on the credit. When the product is done, it moves out of work in process into finished goods inventory. And then when it's sold, it moves out of finished goods inventory into cost of goods sold. So that's the flow of cost all the way through the accounting system, from materials to work in process to finished goods to cost of goods sold after it's sold. As I mentioned, the materials and the direct labor, that's the easy part. The hard part is that factory overhead, keeping track of all the overhead and getting it allocated to the product. We'll have one more video where we give you a little bit more detail on that factory overhead account, help you understand how to handle it. So your takeaways here in our video: you need to know how costs flow through that job order costing system. You need to be able to calculate that estimated or predetermined overhead rate. And you also need to know how to allocate overhead to a job based on an activity driver. In our example, we use direct labor hours. You may have examples where they use machine hours and you're having to allocate overhead to a job based on that driver. You can do it. I have confidence in you, especially if you have unlimited check your works on your homework. I don't think you'll have any problem at all. If you have any questions, I'd be happy to help. Reach out to me and we'll see what we can do. In the meantime, stay tuned for the factory overhead account video where I show you how to deal with that factory overhead account. We'll see you then.